Blockchain Revolution is a fundamental work that explains how blockchain technology is reshaping finance, business, governance, and everyday life. Don and Alex Tapscott provide an in-depth analysis of why blockchain is not just another technological advancement but a revolution in trust, security, and economic interactions. The book is packed with concrete examples of blockchain applications across different industries, demonstrating its real-world impact beyond cryptocurrencies. From decentralized finance and corporate governance to supply chain management and healthcare, blockchain is creating a more transparent, efficient, and decentralized world. The authors argue that those who understand and adopt blockchain technology early will have a significant advantage in the future digital economy. One of the first key topics the authors explore is the fundamental problem of trust in the modern economy. Traditionally, trust has been established through intermediaries such as banks, governments, and notaries. These centralized institutions verify identities, manage financial transactions, and ensure contracts are honored. However, intermediaries can be slow, expensive, and prone to corruption. Blockchain technology removes the need for these middlemen, creating trust through transparency, cryptography, and decentralization. The authors illustrate this concept with the example of cross-border payments. Traditional bank transfers between countries can take several days, require multiple intermediaries, and involve high fees. Blockchain enables direct peer-to-peer transfers in minutes with minimal cost. A real-world example they discuss is Ripple's XRP ledger, which has been adopted by financial institutions like Santander and American Express to process international payments in real time, reducing transaction costs by 40 to 60%. The authors also highlight the inefficiencies in real estate transactions, where purchasing property requires multiple intermediaries such as lawyers, brokers, and banks, adding complexity and costs. Countries like Sweden and Georgia have started using blockchain-based land registries, allowing property ownership to be recorded immutably, making transactions faster and reducing fraud. The authors also discuss IBM Food Trust, a blockchain system that tracks food supply chains. Walmart implemented this system to trace contaminated food in 2.2 seconds, compared to the previous method, which took 7 days. This not only enhances food safety, but also prevents waste and fraud in supply chains. The book dives deep into the concept of smart contracts, self-executing agreements that eliminate human intervention in contract execution. Traditional contracts often require lawyers, notaries, and courts to enforce them, making transactions expensive and slow. In contrast, smart contracts execute automatically when predefined conditions are met. The authors provide a compelling example with AXA's blockchain-based flight insurance, which automatically compensates travelers if their flight is delayed, without requiring a claims process. Another powerful example is decentralized autonomous organizations, DAOs, where companies operate without traditional corporate hierarchies. Instead of CEOs and managers making decisions, token holders vote on governance proposals, and smart contracts enforce the outcomes. The MakerDAO protocol, which governs the DAI stablecoin, is one such example, where financial decisions are made through decentralized voting, eliminating centralized control. Ethereum, the most widely used blockchain for smart contracts, has enabled the development of decentralized applications, dApps, in industries like finance, gaming, and supply chain management. Companies like Uniswap, Aave, and Compound operate without centralized authorities, allowing users to exchange assets, borrow funds, and earn interest in a permissionless financial system. Another revolutionary application the authors explore is the tokenization of assets. Blockchain allows real-world assets, real estate, art, commodities, and even energy, to be digitized into tokens that can be fractionally owned and traded. One example they discuss is Power Ledger, a platform that enables homeowners with solar panels to trade excess electricity with neighbors using blockchain-based smart contracts. This peer-to-peer energy trading system eliminates the need for centralized power companies, reducing costs and promoting sustainability. Similarly, in the real estate sector, platforms like Propi are tokenizing property ownership, allowing users to invest in fractional shares of real estate assets, making it accessible to a broader audience. Another significant example is Beeple's NFT artwork, which sold for $69 million at a Christie's auction, demonstrating how digital ownership is transforming the art market. NFTs, non-fungible tokens, have also revolutionized gaming, where players can own and trade in-game assets, creating a new digital economy. The authors argue that tokenization will extend beyond art and gaming to stocks, bonds, and intellectual property, creating new investment opportunities and more efficient capital markets. The authors also explore blockchain's role in reshaping intellectual property rights, media, and the future of digital identity. Traditional copyright systems rely on centralized agencies like the U.S. Copyright Office, music publishers, and licensing organizations to track ownership and distribute royalties. However, these intermediaries take a significant share of profits, leaving creators with only a fraction of their earnings. Blockchain enables direct, transparent compensation models where artists, musicians, and writers receive payments instantly via smart contracts. A prime example the book highlights is Audius, a blockchain-based music streaming platform where artists retain 90% of streaming revenue, compared to Spotify's 10 to 15% payout rate. The same concept is being applied in digital publishing through Mirror.xyz, where authors can publish content as NFTs, ensuring immutable ownership and royalty payments for every resale. Another major development is blockchain-based identity verification, which eliminates the need for centralized databases that store sensitive user information. Instead of handing over a passport or driver's license, users can verify their identity through self-sovereign identity (SSI) systems, such as Microsoft's Ion, which operates on Bitcoin's blockchain. This eliminates the risks associated with data breaches, identity theft, and third-party tracking. The authors stress that as Web3 evolves, individuals will regain full control over their personal data, deciding what information they share and with whom. Blockchain is paving the way for a future where digital identity is decentralized, financial inclusion is widespread, and creative industries are revolutionized, giving people unprecedented control over their assets, privacy, and livelihoods. A major focus of the book is decentralized finance, DeFi, an emerging financial system that operates without traditional banks. In the conventional financial system, loans, savings accounts, and insurance require third-party verification, and interest rates are determined by centralized institutions. DeFi protocols like Aave and Compound allow users to lend and borrow assets without intermediaries. In 2021, the total value locked, TVL, in DeFi exceeded $100 billion, showing the rapid adoption of this new financial paradigm. The authors compare DeFi lending with traditional banking. While banks offer 0.1% interest on savings, DeFi protocols provide up to 10% annual returns, creating new financial incentives. They also discuss MakerDAO's DAI stablecoin, which maintains its value through algorithmic adjustments rather than central bank policies. This decentralized monetary system represents a shift away from government-controlled fiat currencies. The authors further explore central bank digital currencies, CBDCs, such as China's digital yuan, which provides governments with absolute control over monetary policy and financial surveillance. Unlike Bitcoin, which is decentralized and permissionless, CBDCs allow governments to track every transaction in real time, raising concerns about privacy and financial autonomy. The authors also explore how blockchain can combat corruption, increase transparency, and improve democracy. One key example is blockchain-based voting, which ensures tamper-proof elections. Countries like Estonia and West Virginia have already experimented with blockchain voting to enhance election security. Another compelling use case is humanitarian aid. The United Nations World Food Programme launched Building Blocks, a blockchain-based system that distributes aid to refugees without relying on banks. Through biometric verification, refugees in Jordan's Zaatari camp can purchase food directly using blockchain, eliminating fraud and middlemen. This has reduced operational costs by 98%, ensuring aid reaches those who need it most. The book also covers blockchain in healthcare, where MedRec is pioneering secure medical data storage, allowing patients to control access to their health records while ensuring privacy and security. In their cybersecurity discussion, the authors examine how blockchain enhances data privacy in a world plagued by cyber attacks. Centralized databases, such as those used by Equifax and Facebook, have been hacked, exposing millions of user records. Blockchain prevents such breaches by distributing data across multiple nodes, making hacking nearly impossible. The authors highlight zero-knowledge proofs, ZKPs, a cryptographic method that allows verification of data without revealing sensitive information. For example, users can prove they are over 18 without disclosing their date of birth. Privacy-focused cryptocurrencies like Zcash and Monero leverage ZKPs to offer financial transactions that are verifiable but private. In conclusion, the authors argue that blockchain is not just a technological trend, but a fundamental shift in how the world operates. Just as the internet revolutionized information, blockchain is revolutionizing value exchange, financial trust, and governance. They predict that by 2030, blockchain will underpin the majority of financial transactions, real estate deals, and global supply chains. They emphasize that while challenges like scalability, regulation, and adoption remain, these are temporary obstacles that will be overcome as the technology matures. The book encourages readers to embrace blockchain now, as those who understand and integrate it early will have a significant competitive advantage in the future economy. Thank you for watching. Subscribe to the channel, like the video, and leave your comments. Let us know which other books on blockchain and cryptocurrency you'd like us to review. Share this video so more people can learn about the future of digital assets.